My name is Liam, and today I'm joined by Palmer and Jerry from Whitworth University. We are initiating coverage on Timberland Real Estate Investment Trust, Potash-Deltic, with a buy recommendation. Our valuation is obtained through the discounted cash flow model and confirmed by Monte Carlo analysis and a dividend discount model, giving us a target price of $51, representing an 11% upside. Our buy recommendation is driven by three main factors. First, a continuation of the elevated price of lumber. Second, Potash-Deltic's leverage to lumber prices. And third, its high dividend yield compared to similar financial instruments. What began in 1903 as potash lumber has transformed into a major player in the timberland and wood product industries, as well as an emerging player in the residential and commercial real estate markets. Led by Eric Kramers, Potash-Deltic operates in the northern and southern parts of the United States through its timberlands and taxable REIT subsidiaries. Its taxable REIT subsidiaries consist of its wood product manufacturing operations and real estate investments. Sustainable forest management, biodiversity and conservation, as well as climate change are at the heart of Potash-Deltic's environmental mission. In 2021, Potash-Deltic was positioned as carbon negative, storing and removing more carbon than it emitted. Since publishing its first ESG report in 2019, Potash-Deltic has utilized DE&I initiatives to improve its social score. Women comprise of 32% of all salaried positions, above the peer group average of 22%. Despite board members having industry expertise and former CEO Michael Covey as chairman, Potash-Deltic's staggered 3-year term structure could pose a threat to shareholders. Potash-Deltic's main competitors include Weyerhaeuser, Louisiana Pacific, Rayonier, and St. Joe. Of the 3 remaining timberland REITs operating in the United States, Potash-Deltic has the most diverse operations, lowering its reliance on any one segment. Cash available for distribution is an important metric for Potash-Deltic, as dividends to common shareholders is a key investment driver and a factor in maintaining REIT status. Cash available for distribution year-ending 2022 was offset by an increase in capital expenditures. Demand for timber and wood products is connected to the downstream residential construction market and repair and remodel market activity. Both of these markets make up a combined 51% of lumber by end use. We foresee demand to remain elevated as a result of the historic underbuilding of homes, millennials continuing to drive demand for housing, and strong consumer balance sheets. Supply of lumber is expected to grow, but at a slower rate in comparison to demand. Supply of lumber has been negatively affected by the recent reduction in total Canadian sawmill capacity of 1,700 million board feet, or 12% of total Canadian sawmill capacity. This decrease can be attributed to the pine beetle and previously high Canadian lumber tariffs before the recent decrease down to 12% in August. Now, we will dive deeper into our investment thesis.
The 3 factors driving our total return buy recommendation are lumber price, Potash-Deltic's leverage to lumber, and Potash-Deltic's dividend yield. Moving into our first thesis point, we expect lumber price to stay above historical averages. We forecast an average lumber price of $682 per 1,000 board feet through 2027. Elevated lumber prices are driven by increases in demand with lesser increases in supply. Demand as a percentage of supply is expected to average 94% through 2027, nearly 9% above historical averages. Potash-Deltic is the best positioned to capitalize upon this high price of lumber due to their leverage to lumber strategy. This strategy levers not only their wood product segment, but also their northern sawlogs to the price of lumber. This strategy, in combination with high lumber prices, will generate high cash balances for Potash-Deltic, which they will return to shareholders. Potlatch's average annual historic dividend yield was 7%, nearly 3% above Potash-Deltic's nearest competitor. Moving forward, we expect Potlatch to increase their regular dividend and pay out special dividends from 2024 through 2027. The resulting average annual all-in dividend yield is 7% to our fair value share price. Now, we're going to move on and talk about our financial analysis, starting with mergers and acquisitions. Potash-Deltic has had 3 significant mergers and acquisitions in the past 5 years. Potash-Deltic's most recent merger with Ketchmark Timber Trust is expected to generate $20 million of shareholder value above the initial purchase price through 2052. Moving forward, we do not expect Potash-Deltic to engage in any significant mergers or acquisitions due to the high cost of timberlands. Secondly, profitability. The driving factor in PotlatchDeltic's operating margin is lumber price, as can be seen in 2021. Outside of these volatile lumber prices, PotlatchDeltic's operations are incredibly stable, so we can confidently forecast an average operating margin 3% above historical averages. Moving on, PotlatchDeltic has increased their regular dividend by an average of 1 cent annually since 2017, and we expect this trend to continue. PotlatchDeltic has paid out their special dividend when their REIT status is threatened. This typically happens when cash and cash equivalents exceeds 12% of total assets and is paid out in the fourth quarter. To continue this trend, we forecast a special dividend issuance when cash and cash equivalents exceeds 12% of total assets. Now, onto cost of debt. PotlatchDeltic has the lowest cost of debt in its peer group at 2.4%. PotlatchDeltic secured this low cost of debt by financing at fixed interest rates in 2021 and using interest rate swaps on their floating rate debt. These swaps expire in 2029, and PotlatchDeltic has expressed the desire to continue using these interest rate swaps on debt refinances in coming years. So, we expect PotlatchDeltic to maintain this relatively low cost of debt. And lastly, taxation. REITs are not taxed like most corporations. REIT income is tax exempt if at least 90% of it is returned to shareholders. REITs also own taxable REIT subsidiaries. These are wholly owned subsidiaries with separate income streams that are taxed at the state and federal level, and their income is not tax exempt. To calculate PotlatchDeltic's effective tax rate, we followed the graphic that you can see in the margin of the screen. Moving forward, we expect Potlatch to have an average annual tax rate of 12%. Now we're going to move on to valuation, where we are going to address lumber price, our free cash flow to firm, our dividend discount model, and lastly, our sensitivity analyses.
We utilize multiple analyses to arrive at fair value for PotlatchDeltic. Lumber price is the primary driver of our valuation due to its high influence over fair value. Lumber price is primarily driven by supply and demand economics. When demand for lumber exceeds available supply, we observe harsh price fluctuations in response. Given expected supply for lumber, as well as expected demand through housing starts and repair and remodel activity, we arrive at price projections for the forecast period. Utilizing a free cash flow to firm model, we calculate all cash flows beyond 2027 as a perpetuity, utilizing a 2.25% terminal growth rate, and discounting all prior cash flows, we arrive at fair value. To support our free cash flow to firm valuation, we utilize a dividend discount model, taking a 30-year net present value of all expected dividend cash flows, including both regular and special dividends. To better understand which variables most impact PotlatchDeltic, we utilized a variety of sensitivity analyses, isolating specific variables and measuring their effect on fair value. We find that PotlatchDeltic is most sensitive to the variables of housing starts and repair and remodel activity. This indicates that PotlatchDeltic is more sensitive to changes in demand than it is to changes in supply. Moving on to some risks, wildfire is a primary risk facing PotlatchDeltic. In 2022, over 400,000 acres of Idaho forest land were affected by wildfire. To quantify this risk, we decreased available land for harvest by 20%. This resulted in a valuation impact, decreasing net income by 14% year over year. Due to the high margin of Idaho sawlogs, insects and disease pose similar but less frequent risks to PotlatchDeltic due to their destructive nature. PotlatchDeltic may mitigate these risks by continuing to practice responsible forestry through regular thinning, aerial monitoring, and holding property insurance policies. Canada has continually decreased lumber production since the enactment of high tariffs under the Trump administration. To quantify this risk, we simulate a return to pre-tariff historical Canadian lumber production. This results in a valuation decrease, pushing PotlatchDeltic fair value down to $29.29 a share. PotlatchDeltic may mitigate this risk by lobbying for a continuation of high tariffs on Canadian lumber, as well as continued expansion of their timber business segment. Market cyclicality poses significant risk to PotlatchDeltic in the long term as the housing market cycles. PotlatchDeltic may somewhat mitigate this risk by continuing to stay well diversified in their business segments, thus insulating them from extremely unfavorable lumber pricing. We issue a buy recommendation based on total return for PotlatchDeltic, driven by dividend yield, historically high lumber prices, and high leverage to lumber. Thank you.
talk about the business at a high level, let's walk through taxable REIT subsidiaries. So tell me exactly what part of the business is taxable and what part's not.
Exactly. So Liam, if you could take us to our tax and dividend method, please. So the parts of the REITs that are taxable are specifically REIT income, which is primarily derived from stumpage contracts. This information was provided to us by a past member of PotlatchDeltic Senior Management, and stumpage contracts are a subcategory of the overall timberland business, right? So that is the REIT income, that is tax exempt. Then under the overall REIT umbrella, we also have timberlands, real estate, and wood product segment. Those are taxable REIT subsidiaries that we touched on in the earlier part of our presentation. The revenue generated from these taxable REIT subsidiaries is taxed at the state and federal level, and that income flows back to the firm as cash. And they're not required to pay out 90% of that as a dividend, which most people view as, which most people would think of a REIT as.
Okay, can you just clarify stumpage versus timberland?
Yeah, so stumpage sales are contracts to cut standing timber. The rest of the timberland segment is made up of pulpwood as well as sawlog harvests. Sawlog harvest is just the raw log that they sell to others, and pulpwood are less mature trees that are used in other applications, say paper, toilet paper, poster board.
Okay, great. And then talk a little bit about how they're different from Rainier and Weyerhaeuser, just when we look at the industry as a whole.
So I can cover this one. PotlatchDeltic differs from like Rainier and Weyerhaeuser in that their segmentation is slightly different. So for PotlatchDeltic, they have a more even spread across their real estate, timberland, and wood products business segments. Weyerhaeuser leans more heavily into wood products, and Rainier leans more heavily into specifically timberlands.
And how are these businesses integrated? Is Potlatch integrated all in their businesses?
Could you rephrase the question?
Do the businesses depend upon each other for their daily operations?
Yeah, so in terms of the flow from timberlands to wood products, which is a very natural flow, PotlatchDeltic is not entirely dependent on their own. However, they do utilize a lot of inter-segment sales between those two segments specifically.
Let's quantify a lot. Between 35 and 40% of wood from the timberland segment flows to their sawmills.
Right. And then can you clarify, go to the special dividend part and just clarify the chart there that showed your estimated future dividends was quite substantially varying in future years. So just kind of walk us through how you got to those on the special dividends.
Perfect. Yeah, so our special dividends focus on a tax part of the REIT business when 20% of the total assets generated or held by those taxable REIT subsidiaries, so that's the majority of the timberlands, wood products, as well as real estate, when that exceeds 20% of total assets, their REIT status could be threatened. This typically happens when cash and equivalents are above 12% of total assets, all right? And this that can be quantified in this chart that we're looking at right here. In that green line, you can see cash as a percentage of total assets before that special dividend issuance. We see that it's pretty high, near 20% in 2021, where the brown line is after they paid that special dividend. So we see that cash as a percentage of total assets decrease significantly, which protects the REIT status. So in our pro forma, when we have cash and equivalents exceed 12%, we just take the difference between what cash and equivalents are and 12% and pay that out as a special dividend.
I'll start out with a softball. So, you guys said that they have a negative carbon footprint. How do they do that?
Yes. So within their wood product segment, any carbon essentially from timber itself is stored within that wood product and then gets passed on. So they take that amount and factor that into anything stored or removed. They also remove it through the planting of more timberland. And then to offset that, it's any emissions, greenhouse gas emissions from their mills. So they're around 2.6 million metric tons of carbon negative.
That's pretty cool. So now we kind of get to a little bit of the tougher stuff. So I think you guys, I read your report, I think your presentation, all of you presented really well.
Absolutely. So we believe that the housing industry is going to be supported by the significant, the underbuilding of homes that we've seen since the 2008 financial crisis, right? So leading up to that, we had historic overbuilding, and then houses were extremely underbuilt. So we're sitting on around 4.9 million homes, or a demand for 4.9 million homes. To derive that, we took total household formations, subtracted that by housing starts to get our total underbuilding of homes. Now, this demand is able to be filled by millennials aging into the home buying market, as well as strong consumer balance sheets. Does that clarify?
Have you guys looked at comparisons to like 08, 09 in terms of when the housing market crashed in that cycle?
We have, and so in regards to that, the major difference that we see is that in 08, 09, there was a severe overbuilding of homes. And in recent years, that's transitioned from a severe overbuilding into a deep recession in terms of, we are now 4.9 million homes that, we're 4.9 million homes negative. So there are 4.9 million homes of demand.
Okay. And I don't expect that you guys have done this, but have you looked at the delta of what the cost of a mortgage is, say, by a $400,000 home at 3.2% versus 6.8% in terms of affordability? Because of how quickly, how hard basically the Fed's putting the E-rate on in the car right now on the housing side? Because I think that's critically.
No, we do not know the difference in affordability, the like dollar amount between those two mortgage rates.
Go ahead.
Yeah, along these same lines, I guess one of the things that if you look back at the potlatch stock price over the last 20 years, there's been lots of intra-year swings over a 24-month period of time where the price moves by greater than 50%. Why is that?
Can you restate the question, please?
Just why the stock has been very volatile. It's not a Procter & Gamble that steadily chips away. There's a lot of volatility within this value. How do you come to that? Why do you think that is?
Yeah, so Lee, if you take us to our beta, our WAC and ROIC slide. So we've especially seen it be volatile in the past 3 years, primarily due to their leveraged lumber strategy, which has bumped their beta from around, so we're going to look right here, bumped the beta from around 1.9 to around 0.2 due to the implementation of that strategy, because they're more levered to lumber, which is a volatile commodity, right? We also see this same trend with Weyerhaeuser and Rainier as well. They also have high betas. Rainier is the least volatile because they're not leveraged to lumber. They're mainly timberlands.
The betas are around 1.
Was around 1, has now transitioned to around near 1.2 due to that leverage to lumber strategy. When they implemented that strategy 3 years ago, that's where we see the beta bump from 0.9 up to 1.2.
Potlatch Deltic reacts strongly to changes in the volatile commodity of lumber, which is where we see those large price swings.
Yeah, okay. So when you go into your model, if you move the price of lumber by say $100 a board foot, what does it do to your model? One way or the other. How sensitive is it to the changes there? And then also a follow-up question is how sensitive is it to changes in southern sawlog pricing?
So we find that Potlatch Deltic is extremely sensitive to changes in lumber pricing. Was that not on this slide?
We don't have a specific sensitivity analysis showing the change in price connected to the our annual average lumber price. Potlatch, because of their leverage to lumber strategy, is extremely impacted by changes in their lumber price, right? They're the highest levered out of all the timber REITs, so they're going to be the most impacted by that. To address your second question, southern sawlog pricing. Southern sawlog pricing is incredibly stable. We've seen southern sawlog pricing pretty much bounce in a band between $44 per ton to $46 per ton over our historical period from 2017. This is due to overgrowth in the south, sourcing and oversupply. So it's really a buyer's market, which keeps that price very steady. And that trend is expected to continue, which is supported by the member of senior management, the past member of senior management that has since retired from Potlatch Deltic.
And do you think, if you move the southern sawlog prices up or down 10%, what does that do to the EBITDA of that segment?
Southern sawlog pricing is not, or the southern sawlogs specifically, are not as high margin as their northern. So bumping it down definitely crunches those margins. We don't have exact figures, However, pushing it up would definitely result in a significant increase to their margins. In terms of northern sawlog, we see most of their EBITDA come from that section specifically. So southern sawlog is less significant to their overall business operation than northern, in terms of a 10% move either way.
And to contribute to that response, the saw logs flow directly into their mills, right? So when we see an increase in the saw log price, say in the south, which has been historically low, the margins for their wood product segment in the south gets crunched. So we kind of see that that dichotomy between the north and the south.
I'll come back to Billy's earlier point about just the sensitivity of lumber price. Your chart only goes back to 2017. How come you didn't choose to go back 20, 30 years on that chart?
When we were looking at lumber price, we did go back farther. We just chose not to chart it.
Because if you go back further than what that chart shows, it falls well below the $400 for much of the last decade. So essentially, post-COVID, we take a massive step up, and you're saying that we just had a step function higher, and that we're going to be at a new plateau going forward in perpetuity.
So to calculate lumber price, we use demand as a percentage of supply. So as demand makes up a larger percentage of the available supply, that pushes lumber price up. We took our correlation going all the way back to 2005. We took our correlation going all the way back to 2005, looked at demand as a percentage of supply. We can get into how we calculated, we forecasted demand or supply if you would like as well.
Great, that hits our official 20 minutes right there, so.
Oh, wow. Okay.
Yep.
I got a lot more questions.
Hey,